One international group says that reverse mortgages remain a last resort, but one whose demand is likely to grow. The World Bank Group has a large geopolitical footprint. According to its website, it has a staff from more than 170 countries, and it functions as a global partnership to reduce poverty and build shared prosperity. Now, the group, or the state of the reverse mortgage marketplace, and the potential benefits and risks of the program are examined in the group's January research paper. However, beyond the mere claims that the loan remains a loan of last resort is the critical analysis of supply-side challenges and limited market providers. Despite those challenges, the World Bank Group does see value in the loan when it considers the reverse mortgage's ability to help cushion against financial shocks and also smooth consumption of accumulated assets. The ways that reverse mortgages can benefit the elderly population is impressive, says the report. One functional weakness, according to the group, is elder care, a need that is growing across both developing and developed nations. The reverse mortgage is a flawed healthcare insurance tool because it does not address elderly care risk. In accordance with reverse mortgage regulations, it must be repaid after the last borrower leaves the home. If deteriorating health obliges an elderly person to move into an elder care facility, they face the risk of loan termination at a time when their health expenditures rise significantly. One challenge that is well known to reverse mortgage professionals, such as many of you watching, is the gap between the loan's potential to improve an elder's monthly cash flow and what researchers call, quote-unquote, a lukewarm response. In addition to consumer risks are those to lenders, namely adverse selection and moral hazard. Borrowers who remain in their property for several years and are in relatively good health do contribute to adverse selection as the loan balance grows considerably over several years or decades of deferred or no payments at all. And longevity creates for lenders and insurers another risk because the loan's balance accelerates significantly with negative amortization, especially when you have a high lump sum starting loan balance. The research does add the caveat that the evidence of adverse selection is merely anecdotal, so keep that in mind. Both federally insured and private reverse mortgages mitigate that risk with adjusted principal limit factors or lending ratios that adjust the available loan proceeds based on the borrower's age and assumed life expectancy. One particular finding is quite interesting. Despite longevity risks, studies have found that reverse mortgage borrowers are more likely to sell their home before they die. And one theory on why we have that is because reverse mortgages are often taken to address a chronic medical issue or health emergencies, and those reduce their life expectancy. One market failure that the U.S. reverse mortgage is seeing is moral hazard. The report says homeowners who sign a reverse mortgage have less incentive to keep up with their house and pay property taxes. The borrower will never have to repay more than the house value, and thus they may seek to avoid expensive house repairs. Now, of course, we have the assessment, but each of those may lead to a technical default and deferred maintenance of the property nevertheless, and that reduces the value of the asset that secures the loan's ultimate repayment. Despite being generally considered a loan of last resort, researchers do note the shift in likely reverse mortgage borrowers. Given high non-interest costs, only citizens with housing equity above a considerably high threshold may find reverse mortgages beneficial in developing countries. In this case, reverse mortgages represent more of a wealth management tool for the better off than an instrument to address old age poverty. And that confirms what many in the industry see as a move toward the mass affluent and away from what we call the needs-based borrower or house-rich, cash-poor. Now, one of the more striking suggestions that is cited in the paper is a work of two researchers in their 2017 edition of the Journal of Finance. They argue that the existing FHA insurance scheme should be abandoned and instead the risk passed on to lenders and to the heirs. That would make the reverse mortgage significantly cheaper and increase consumer demand. The World Bank Group's paper does remind us that while reverse mortgage loans have been with us for many decades, the unique intrinsic challenges of the loan and the increasing global need for retirement cash flow may push lenders and regulators alike to re-examine our current approach. Now, what are your thoughts? You can leave your comments below, and don't forget you can share this video using the links on this page. And if you watch on YouTube, be sure to subscribe so you never miss an upcoming episode. Thanks again for watching, and be sure to return next week.